Hunting for that magical genie with piles of cash? Join Candace and her guests as they uncover financial secrets, have a laugh at past mistakes, and savor financial rebounds. Thank you for listening. Let's dive in and do something today that your future self will thank you for.
Hello, everyone, and welcome to the Money Flow Genie podcast. Today on this episode, I want to talk to you a little bit about the pressure to compare yourself to others while you're moving forward in your financial journey. I had a big aha moment in this where it was an actual comparison where I was on a team that we had to share our financials because we might be signing a loan together for a multifamily property. Now, this person from the exterior looked as if they were doing amazing. And I was like really in awe of their success. They were buying the single family homes multiple times over and over again. In that 1 month, I think they bought 3 single family homes. And I'm like, how on earth are they able to do this so quickly? He's, working a full-time job, must be making a ton of money. Like, how is all this happening? And that's when I got the big aha moment that never to compare yourself with someone else. So in 2008, I'm going to jump back. The reason that there was a collapse with the banking system is that they were over leveraged. Like they were giving money loans to people that there were no income verification loans and with maybe a little bit higher interest rate, but no income verification. Well, who would not take advantage of that? And so they gave a lot of loans to people that went into default. There were some other scenarios that happened with that, but the whole system broke down, and it was because it was over leveraging. So now let's bring that back to what I was just talking about. So in your personal finances, you have what's called the net worth. Well, if your debt exceeds how much you are actually your net worth, meaning everything that you own all piled together minus the amount of money that you owe on it, is your net worth. And if your debt is greater than your net worth, then you're upside down and you could crash and burn at any time. It just takes a moment for a bank to fold and the loan being called, and you have to come up with that cash to pay that off. There's so many variables around it. And so going back to what I was just recently talking about, I had been comparing myself and actually starting to feel a little less than, like, what's wrong with me? How come I'm not succeeding this quickly? And then I saw the financials and I was horrified to see that this individual was in $3 million of debt and had a net worth of only 600,000. That was crazy. That was just like disastrous. Now, how could he get that way? Well, the banks were not, they were actually offering the similar type of loan packages that they were doing in 2008. And I just hope that those banks are able to continue moving forward because it's insane. Do not take advantage of something like that. If you do 1 or 2 of those types of loans, but don't compile so many that your net worth is less than how much you owe. And that's how we go backwards. Particularly in purchasing real estate, debt is necessary. Yes, there is a good debt and there's a bad debt. Bad debt, of course, is credit card debt. But you know what? Debt on a single family home or any type of real estate can be bad debt. What categorizes that? So let me touch with you on understanding the loan process. There's lines of credit. There's a HELOC, which is the line of credit you can get on your personal residence. It's basically a loan against it. There's also just your regular mortgage. And then there are commercial loans. If you're buying, say in real estate, housing that has, 4 units and up is considered commercial. They're totally different qualifications for those types of loans because the asset itself is what provides the income. And those are easier to get just for the sake that the income from the coming in from the property is used as showing as income to help pay for that loan. So you can get a loan for a larger multifamily property easier than you can for a single family residence that you're going to be renting out and using that as income. So that's something to take into consideration. And you would really want to talk to a lending broker around that because they can find the best deal. They'll be working with people that they work with banks, they work with different types of private lenders that do more of commercial lending. And they work on your behalf as opposed to you providing all the financials that you would have to do anyway. But they go to various sources to get the best deal for you. And that's why you're paying them like a 1% fee for their work, but they're really working on your behalf. And it's really worth looking forward into if you're going to be doing some kind of multifamily investing. But when you're looking at a loan, you want to look at what's called the loan constant in addition to the rate. The rate is like, that's all we're taught. And that's not necessarily the right way to look at something. So the loan constant is basically, it's the gauge in the mathematical formula that tells who is taking on the most risk of a loan. So if you have a loan that you have a loan constant and the interest rate is high, it doesn't necessarily mean that the loan is a bad loan if you have a high interest rate. What you're going to be looking for with the loan constant is, let me use an example of a single family home, which most people are familiar with. Often the loan constant on a 15-year loan for a single family is going to be higher than the risk factor is going to be higher than when you would have a 30-year loan. Now, why is that? Well, I'm paying it off faster. Well, the risk is actually put on you as the borrower. And that's because you don't really have much flexibility. Let's say you get a loan for 15 years and you have X amount of this, let's just make up an amount, $2,000 to pay. And then something happens and you're not able to work and your insurance is not, or your health benefits are not paying you your usual income, which it usually is not, and you're short. Well, you don't have much flexibility in that payment plan. You have that $2,000 a month payment is what's fixed that you have to pay. Now, if you had went ahead and gotten a 30-year loan, well, if it's amortized over 30 years, that payment is going to be down. Yes, you will be paying more interest if you pay it off in the whole 30-year term, but you have more flexibility. So the loan constant is down and where is the risk? It's on the bank. And so that's where the banks are actually pushing you into these like, oh, why don't you do a 15-year? We'll give you for a 15-year loan, we'll give you 2.5 interest rate. Now we know those don't exist anymore, but I'm just using this as an example. And then for the 30-year, you'll have a 5% interest rate. But then if you ask them, well, tell me what the payments are, that's what you need to focus on. What does the monthly payment do on a loan for a 15-year? And what is that same loan for the same property? What is it for a 30-year? Pay attention to the actual monthly payment. And, obviously no prepayment penalty type of thing. Don't want to have any of that in there. And that's pretty general. But if you look at that, you will see that you have flexibility because you don't know what's going to happen down the road. And you also will then have the flexibility to take money, put more money towards the principal. And you can take a 30-year mortgage and you can reduce it just by adding extra payments in each month per year, just adding a little bit extra and directing it straight towards the principal, you can create the same type of end product of a 15-year loan in a 30-year, but you have flexibility because your monthly payment is much lower. So there are ways to play with that, but it's something to take into consideration. Another thing is that there's a lot of places out there, like I noticed, I use QuickBooks. And I really love the platform, and I really love the fact that they have now a capital lending aspect to it, which I have utilized. But one thing about these loans is that they're short-term loans, and short-term loans are really high interest rates, and their loan constant, it actually creates the risk is on the borrower because you have to pay that back in a short period of time. So they will tell you, oh, look, you qualify for $50,000 in a loan. But what they're not telling you is that that loan has to be paid back in 1 year. So just divide 50,000 by 12 and then add the interest on top of that. And that's what you're going to be. Are you going to be able to come up with that? Like maybe I'm just going to make up a number. Would that be maybe somewhere around, close to $4,000 a month? Wow, I got $50,000, but am I going to be creating $4,000 a month guaranteed for a solid year to pay that off? Is that going to work for me? How is that going to work? So it's really important to look at the term, how long you have to pay off a loan, and not necessarily interest rate, because your loan payment may not be that much difference between a 15-year and a 30-year. It may be very insignificant, maybe $50 a month. But if you pay a little bit extra towards your principal, whether it's a one-time lump payment or whether it's ongoing, you can basically make up that difference. But they're not going to tell you that because they're going to want to put the risk on you, they meaning the bank or the lender. The more risk that's on the borrower, the better for the bank. That's just business. But we're not really told that. And I wanted to share that with you. So when you go to look, let's say you are going to be getting a loan, or you see one of these platforms that are offering you even a line of credit, you want to find out what the details are around that, because each of these types of loans, they all have their own nuances to them and rules. And each lender is going to have their own rule. So no lender is going to be uniformly the same across the board when it comes to particularly lines of credit, which are hard to get. And that's why I hope you really pay attention to the episode that I'm going to have with someone with whole life, and I'm going to bring somebody in with index universal life. Because with both of those, you can create your own line of credit with your own terms. But you want to utilize those policies correctly and not overstress them where they collapse, because that can be done too, and that's not really spoken about. But so I'm just paying, in this particular episode, I'm just saying, pay attention to the loan constant, pay attention to what exactly are the terms and where's my flexibility. That's what you should be focusing on, not the rate, but where's the flexibility for me so that I know I can definitely make this payment throughout the future. Doesn't seem like it would be something to stress me out. But just because it's shorter, it may not necessarily be better, because there is a good debt and a bad debt. And then how you then, incorporate your finances to work around those debts, that's also what makes a good debt a good debt. So I hope this helps. And I look forward to being with you on another podcast episode. Thank you so much. And remember, you're your own genie in the bottle. Thanks for listening.
The info in this podcast is straight from our personal experiences. You alone possess the power to manifest your desires. You are the genie in the bottle, awaiting your command. So ask smart questions. We're not licensed financial pros, so be sure to consult with a licensed professional, attorney, or tax consultant.